What is the hottest stock this month? Opendoor. Coming up, we'll speak to the investor whose comments led to a surge in the shares, and he'll explain why he thinks the stock can keep climbing. So hit that subscribe button and let's get started. This is Ticker Take.
John, the summer weather is hot, but Opendoor's stock is even hotter.
You're right about that, Caroline. Now, this is an online real estate platform, and the shares got a big bump after an endorsement from the hedge fund manager, Eric Jackson.
Eric recently came on to talk about quantum stocks. If you haven't checked that video out, you should. And actually, many of those stocks went up since Eric came on.
Yeah, and he's also made some notable big calls in recent years. A great example is Carvana, which he was buying back in 2023 when not a lot of people were.
All right, let's hear from Eric now about why he's excited about Opendoor. But first, a friendly reminder, this is not financial advice.
All right, Eric, welcome back to Ticker Take. Thanks for joining us again.
Good to see you.
Okay, first of all, Opendoor, what does this company do?
They pioneered something called iBuying. So imagine you want to sell your house, but you don't want to sit around and wait for the agent to deal with and pay the 6% agent fee to that person. What if you could just go online, sit at your computer, type in your address, and see what your house is worth? And not only do you see what it's worth, but the company at the other end makes you a cash offer for it. And if you accept, we'll wire you the funds within days. That's the original business plan that Keith Raboy came up with and Eric Wu for Opendoor. They built out a national platform. They've obviously got to borrow a lot of debt to do that. It's a risky business because when you buy houses that are expensive and then they sit on your books for a long time and you can't sell them, turn around and sell them, you lose a lot of money. And that's where Opendoor got into problems. But that's their core business. They're the only national iBuyer left. They're also experimenting with expanding into a situation of partnering with agents who traditionally have hated Opendoor because they're sort of a competitor to them. And for people that want to know, like, okay, we could take a cash offer with Opendoor for this much, or you could work with the agent for and seek to try to get a better price yourself. They're also doing that as well. So that's what they do.
And why do you like the stock?
I like them because this is a cheap stock. That's not just cheap, but like priced as if it's going out of business cheap and will never come back to life cheap. And I think that there are plenty of signs that this, not only are they going to remain alive, but they're actually about to turn the corner to get to permanent profitability over the next 6 months and have a total re-rating of their stock price because they have no competitors left that they're facing, as well as a softening macro environment that leads to much higher volumes and much higher profitability for them. I mean, this thing was left for dead on the side of the highway. It was like worse than roadkill. It was like chucked off in the ditch. And I think people just got over their skis in terms of pronouncing its death before it really was done. It had this sort of last throes of dying, once it got below $1, and all these funds were selling, and there were rumors that it was going to get kicked out of the Russell 3000 and stuff. Anyway, if you step back and you just look at this company, it's a company I've liked for a while. I've expected a Carvana-like turnaround for a while. It didn't come. It took a lot longer than I expected. I was wrong for a long time, or early, whatever you want to say. But I could see signs that this thing, could make an epic comeback. Starting in a couple of weeks, they're going to report their latest earnings. They've already hinted that it's going to be their first EBITDA positive quarter in 3 years. And I think it's going to be the first of many to come. And so it's a fundamental turnaround story. This is not GameStop. This is not AMC. This is not BlackBerry, where for whatever reason, people got fixated on some weird company. This is a valuable company that's doing a service now nationally in the US, where allowing you to sell your home online if you want, where there basically are no competitors left nationally. And with the changing macro environment, and probably we're going to see rate cuts in the months to come, that's going to mean huge volumes for Opendoor on a much leaner and meaner platform. And that's what could conceivably take this from a sub $1 stock to an $82 stock by 2028.
Well, since you're looking at it with the fundamentals, let's just talk numbers for a second. This is a company that generated somewhere in the neighborhood of $5 billion in revenue last year. I was looking at the projections on Wall Street on how much revenue it could generate in 5 years' time. On average, according to Bloomberg, analysts think it could get to around $12 billion in revenues.
Yeah.
So, I mean, is that in line with your own thinking?
Well, yeah, they do revenues, like big revenues, like you said, $5 billion last year. They're supposed to do almost $6 billion in 26. By 29, like you say, $12 billion. Problem is that they've been losing money. And the market just hasn't been willing to give them any credit for this top line revenue because there's sort of been this understanding that they're never going to be able to have a goable business here, and they've got so much debt. This thing might go bankrupt, in which case, obviously, the equity goes to zero. So there hasn't been any kind of willingness amongst investors to give them the benefit of the doubt. I think it's going to happen once they see a profitable quarter and they see a sort of a line of sight to a steady state profitability. And if that's the case, and you can get to then you have to say, well, what are they going to be valued at? And take a company like Carvana. Now that's a stock that went from $400 to $3, and now they're basically back to 400. If you track what their forward EV or enterprise value to revenue multiple was during that whole kind of U-shaped phenomenon. They were a growth darling for a while. They were valued at 6 times forward revenues pre-pandemic. At the lows, they only got 0.5x of revenue multiple for their business because, again, people thought they were going to go bankrupt. And now they've come back, they're at 4 or 5x. If you think that this Opendoor is going to make it, it's reasonable, I think, that they're going to get a 5x type forward multiple of revenues. And for a $12 billion number in 29, that translates into the $82 share price that I've been talking about.
Well, you made those references to Carvana, and we were mentioning earlier in this video that you caught a lot of people's attention. You had been pounding the table on that company, and it was around $11, I think, was when you were looking at it. And so now people are very curious about what your expectations are for Opendoor's stock and how much upside you potentially foresee for this company.
Well, I mean, this is going to be a true 100-bagger in my view, and
Really?
I want to be able to say I was there from the start to finish. I wasn't, Carvana is now a 100-bagger. Unfortunately, I didn't get in at 350. My AI model, you're right, told me I should get in at $11 in May of 2023, but I thought the AI model was broken. I thought it was hallucinating. I told the engineers they were wrong. They had to go back, rip everything up, make sure that the thing was right. By the time they did that 2 weeks later, they said, sorry, boss, it was right. I bought the position at $15. I probably, the truth be told, I sold the bulk of my Carvana in the 130, 150 type of range. And the reason why is I was thinking, gosh, I've made so much money. I've had like more than a 10x here. I still like the company. I still think it's going to go up. And you know what? It might well go to $400, but I know this company so well. I'm so smart an investor. I'm going to trade in and out of it because it's very volatile. This thing is, goes up and then it goes down and so forth. And so I'm going to be smart enough to perfectly time it. And I never was, John, what I learned through the whole experience was, with these kinds of companies, sometimes the best thing you can do is just turn the TV off, walk away. Don't worry about whatever the macro headlines of the day are, like Trump tariffs or whatever. Sit on your hands, buy your stock, when you can at the beginning, hopefully at the beginning of a big run, and then just do nothing, and just walk away because you are never going to be some sort of perfect market timer.
All right. And with references to AI, which you made earlier, you have started to incorporate AI into your investing, and we've actually covered that on Ticker Tick in the past. But I'm glad you brought up volatility because when it comes to this stock, certainly if you look at all the excitement after you started talking about it, immediately that invited a lot of meme stock frenzy talk. Even though you're looking at the fundamentals, you just mentioned it, different than some of those other meme stocks that have gotten a lot of attention. It also has a high short position. And so I guess if people are looking at Opendoor, should they be ready for volatility, in your opinion? For
sure. And it works both ways. Like as we're recording this, the thing's having like an up 90% day. I don't think I've ever experienced that. That's volatility, but it's the kind of volatility nobody gets mad at me about. I usually get the calls from the investors when it's the downside downside volatility. Oh, we had a terrible month. We were down 40% in the month and all this kind of stuff. So everyone hates that volatility. Nobody minds the up 90% volatility. And the fact is, though, that, to get, if you want to nail a 100 bagger, they're very rare. Most of us will be very happy if we get a 10 bagger or something out of a particular stock. The fact is that they were probably cheap for a reason. There's probably a lot of people that hate this particular stock. People hated I didn't know, one other person who was bullish on Carvana when I was like pounding the table for it. Everybody was saying this thing's going out of business. It's circling the drain. There's a lot of people that hate Opendoor. They're hated because they've gone down so much. They've lost people so much money. And so there's high short interest. There's probably a lack of profitability or a lack of clear, line of sight to profitability. And so just in companies like that, they might not have a perfect quarter every quarter along the way in the comeback. And when they do, everybody jumps out of the bushes to say, see, I told you, these guys are a bunch of bozos. There's a reason why the stock went from 400 to 3. They're terrible. They don't know what they're doing and all this kind of stuff. Fears about margins and margin compression and competition. I mean, you'll hear everything. So you just have to be able to see through it, be prepared for those volatile days. And as long as something fundamentally doesn't change in the story, and you truly believe that Opendoor is going to come back or a Carvana is going to come back, just stick with it and tune out the Twitter trolls.
Okay, so that was going to be my final question to you. For those who are curious, how long are you willing to stick with it? You told us about the experience you had with Carvana as well. Mm-hmm. But how long do you see yourself staying in a stock like Opendoor, depending on what happens?
Well, probably the first turnaround stock I ever got involved with professionally was Yahoo, like 20 years ago. And there were a lot of lessons I learned from that and a lot of reasons that I should have concluded much sooner than I did that this management wasn't, truly committed to doing the right things to turn things around. So, I mean, the answer is every case is different, and, you shouldn't be so locked into a stock because your hearts and dreams are like, I want this to be my 100 bagger, that you're sort of looking past, the obvious flaws or mistakes that maybe a management team is doing. I think if you think this management team is not committed, is not doing the right things, is sort of taking the company in a weird direction, I mean, you got to reassess. You can't get so locked in out of hope that you miss like some fundamental reason that maybe you simply got it wrong up front in your due diligence on the company.
All right. Eric, thanks a lot. Really appreciate it.
My pleasure.
All right. Our thanks to Eric Jackson for sharing his take on Opendoor.
But we're not done with Eric yet. In our next video, he's going to tell us about 10 AI companies to watch.
Yeah, so make sure to subscribe so you're first to get that list of stocks. See you next time.